Well, welcome everybody. Thank you for being here, and it's great to see you after quite some time. Christoph I saw recently in November, so welcome back to the Phocuswright Center stage. I'm going to start off with a very general question. So, from your point of view, as investors, what do you think the state of the travel industry is at the moment? And then can you narrow that down as it relates to the startup ecosystem and the ventures or the funding ecosystem? So Suzanna, let's start with you.
Sure, happy to kickstart the conversation. From where I sit, I'm the startup investment program of Amadeus, right? So what we have access to is search data. So within our platforms, what we've seen is that in March, so the last month, the number of searches that went through our system has already gone above the year 2019 level. So this is a very encouraging sign that we're seeing in terms of where the market is at right now. From an investment standpoint, so where I sit personally, so within the organization, we're definitely seeing a lot of high-quality deal flows as they're talking to a lot of the travel startups who are ready to fundraise right now. And we have a very strong pipeline that we're executing right now.
Great. Christian, what do you see?
I mean, I would say we have a pretty paradoxical situation right now. I mean, the travel industry has been through a very rough phase in 2020 and 2021, of course, because of the pandemic. And now since the end of last year, beginning of this year, we see all travel companies, in particular all startup companies, coming out really strongly from this rough phase. And most companies I know are above 2019 booking levels, and usually with much better unit economics, much better results in general. Partly, I guess, because there's a lot of pent-up demand for booking travel, but also because most of the companies I know have been improving their products and their processes and their technology a lot. And so everyone is coming out very strongly of the pandemic. On the other hand, and that's a little bit the paradoxical situation, the funding markets have become much more difficult over the last 3 to 6 months. And so I would say on the funding side during the pandemic, after a first half of 2020, that was really tough, but afterwards there has been a lot of capital around. It was relatively easy to get funding, and that's not only true for the travel industry, but in general. And over the last 3 to 6 months, getting funding has become a lot more difficult. So in that sense, operationally, everyone is doing very well. On the funding side, things are a little difficult right now.
Christoph, you agree?
There's not so much to add because, what Suzanne and Christian said is absolutely true. So I think maybe just taking travel a bit aside and more looking from a helicopter perspective, what is going to happening in the markets. I think all the transportation-related companies in our portfolio are performing. Beside supply-side scarcity, beside Corona post-pandemic or mid-pandemic or whatever it is effects. And the travel companies, I think, as Christian mentioned, they're in a good shape now and they were ready to do the next great fundraising journey. And then the markets are switching into a more winter situation. So I have to say for every founder who is in that market, it's really tough because they managed the pandemic. They managed, let's say, to get the aspiration and the culture within the teams on a proper level. And now they are about to start to fundraise and they get this kind of negative clash again because the multiples are coming down from public markets and this affects especially the growth portfolio companies and the push and the pressure on path to profitability. That's what we also see, that let's say the investors are question marking path to profitability, margin improvement, margin step up. So again, new challenges. And I have to say, we are really proud about our travel founders who are managing 2 crises in a row. And that's not the end of the story. So let's see.
Yeah, and you know, it's funny because, well, not funny, but when we track startup funding for travel startups especially, at least through, well, May 2022, travel seemed to be doing pretty okay. When you kind of read about, you know, the general market trends, et cetera. Do you think that is a sign of confidence that the travel sector is going to rebound, or that in the long term travel is still, you know, a great sector to invest in, which I think this audience certainly will agree with? Or do you think that is just a, you know, a timing, question of timing, and that these are companies that have been in conversations before and it's just kind of coming to fruition?
Yeah, so we call it pipeline effect.
Yeah.
I think there are a lot of rounds which were already in the making in January and February. Let's say the trustful investors, they don't try to change the valuation things or other topics. They go through it because they are long-term partners of the entrepreneurs. And the rounds which you see, or which have been announced within the last 8 weeks, I would say they were all in the making over the last 2 to 3 months. So let's take Omio as an example. The round we announced, the $80 million round, that was already in the making for a longer period of time. And some of the rounds are, let's say, in terms of getting the runway up to 24 months, 18 to 24 months, founders are coming back to the investors and saying, hey, we want to get the runway extension. And this is something we are happy to do if we have the full trust to the team. And that's also a kind of mixture of a depot effect on already existing pipe plus runway extension rounds. I think it's not new, it's less new intended rounds which are not, which haven't been in the making before.
I would still sort of add to that travel companies are in a better shape today than most other B2C companies in terms of what the funding markets are looking at. And that is related to what Christoph described, which is sort of the 2 crises in a row. Because the funding market right now looks much more at economics and profitability rather than growth compared to like a year ago. And sort of for a lot of the other B2C companies, that's a really big shift of what they've been looking for over the last year. If you look at the quick commerce companies like Gorillas and Flink and so on, I mean, they didn't care about profitability at all over the last year. They just looked at growth. While travel companies, they were just forced in the pandemic to really look at their cost structure and at their economics and, yeah, at minimizing burn rates, and so they have gone through a lot of the tough changes that most of the other, in particular B2C companies, have to go through now, and so they are in a better shape now. So while I agree with Christoph that probably right now not a lot of new rounds are happening, I still expect more to happen in the travel space than in other B2C spaces.
Yeah. Well, I would like to add a positive spin on it, like in the sense that I think the COVID pandemic brought into the limelight of like a few new challenges that like the travel industry is facing. Right? Is that we realize that there are processes that can be automated that may be a little bit too manual in the past. So there are new opportunities that are being created as well. Like and I think like investors are recognizing those investment opportunities and are funding them. So that's kind of like the last note that I would like to add.
Yeah. And it's nice to hear you say that the travel industry is actually ahead of the curve, you know, yeah, for a change. But all 3 of you mentioned sort of this profitability and like looking at profitability and as a criterion. Is that different, do you think, to the way that we were looking at investments in the last 2 years? Or how's your criterion now changing when you're looking at what investments to make?
Yeah, I can
yes,
start. So
I
have to say, it's on the one hand the classical unit economics view. So a lot of travel startups, I think they especially in the B2C segment, they have to show that, let's say, this CAC CLV gets better, that the cohorts are getting better, that returning customers are improving. And that is in some markets not as easy than in others. For example, in tours and attraction markets, in vacation rental. So recurring behavior is different to other businesses. But if you have on-site customers and you have the possibility to track, I think then, for example, we are looking heavily into recurring customer behavior, so to avoid the B2C costs in terms of customer acquisition costs. That is the first thing. And in terms of path to profitability, I have to say, I think, Christian, you mentioned it, so pandemic helped that travel startups started a year or 2 years earlier in terms of path to profitability compared to other B2C models. And for us as investors, we are now, for new investments, more looking into B2B infrastructure because we think it's really expensive to build new B2C brands. And the market is not there to finance totally new brands. I think if the brands are already in the market and they have their footprint, it's fine. Let's take the Get Your Guide as an example, or Home2Go from or Lime Home or others, or Omio. But now to ramp up a new B2C brand in that market environment, I think it's really complex in terms of financing.
And I mean, I think that has been the case for a couple of years now, and all the companies you mentioned are a couple of years old, or Get Your Guide like more than 10 years old already. So it has been quite expensive to build a travel brand on the B2C side for a couple of years now. But I think investors are now really focusing on that, and that's different to what we had like before the pandemic and even during the pandemic. And so I just had like a board meeting in one of my travel companies 1 or 2 weeks ago, and I remember that like 2 years ago, before the pandemic, we almost didn't discuss unit economics because it was all about like growth and land grab, and that's very, very different now. Everyone is looking at how unit economics work and how profitable this can be, which is also something you see in the public markets, like the companies that holding up best are the ones that can actually show profitability and profitable growth, and the ones that are only about revenue growth but cannot show the profitability, they've been heavily impacted.
Yeah. You agree? Okay. This morning we had a panel. Someone described, or a couple of people actually agreed also, SPACs and the word association with that was bloodbath. Now, last year we were talking about SPACs and how that was kind of, just the way to the public markets. Seems like that bubble's burst, but say you're talking sort of to your portfolio companies, perhaps other companies that are looking to exit. What advice would you give them? What will it take for those companies to exit if they were looking for something in the near term?
I'll go last with the corporate perspective. So let's go.
I mean, basically what we are telling our company in particular now, like I would say in general, exit markets are maybe not fully closed. I think IPO markets are closed, and SPACs, there's still some overhang from the boom times. There's still, I think, a couple of hundred SPACs out there that needs to find the target to de-SPAC, or otherwise they have to give money back to the investors. So there's like still some overhang from the past that might result into deals, but I think there's almost no new SPACs going public right now. There might be some M&A activity, but in general, like exits are going to be very difficult in the near term, and who knows, maybe in the medium term. So I think what we are telling our companies is to just build like strong, profitable businesses that are self-sustainable at some point, and then like the right exit opportunity will materialize at some point. If you have a great business, if you're profitable, then it doesn't really matter whether you go public or do an exit now or in 2 or 3 years. But if you have a business that is heavily dependent on financial markets, on the exit markets to survive, then I would say you have a problem right now.
Christoph?
Yeah, it's, I think, as I said, we are trying 18 to 24 months runway. So runway extension is the first thing. Second is, let's say, be under control of your path to profitability. So, for example, if companies have the chance to go international to the US, then they should think about, is there something they miss if they don't do it as aggressively as they have planned it a year ago? So then I would go for, find your core market where you are already profitable. Let's say, have a story for your investors that you can reduce speed by being less aggressive on the new markets and more focusing on the home markets. If you have this kind of setup where you can always switch into a less aggressive but profitable growth, I think then you're in a good shape. And that is often a going international decision making. And I have to say we are a bit more conservative at the moment, which is normally not our case we are, but so we have a guy from Morgan Stanley within our team, within our London team, and he's looking into this kind of cycle, and his view is that we have too many dimensions, let's say, not under control at the moment. It's not only supply, it's not only, let's say, inflation, it's not only past pandemic. There are too many dimensions in parallel. That's why we are thinking that the downturn will take longer than in a normal 6-year cycle. And that is something, maybe we are proven wrong, but so we are here a bit more on the conservative side.
And Suzanna, I know you're corporate.
Exactly.
So I guess the question for you, and I will turn this over to you guys as well in a minute, but how do you support your portfolio companies at the moment? I'm guessing they need a little more advice and a little more help, as Christoph said, for that runway extension.
Absolutely. So for us, Amadeus Ventures has always been a strategic investment vehicle. So which means that we write checks on the one hand, but at the same time, so we also look at what other assets in the company that we would be able to use and leverage and be able to support our companies. There are a couple of ways, our network, within the travel industry, is obviously a big asset. So if there are common customer segments, if a startup is trying to target the airlines, the hotels, there's a lot of opportunities for us to see how we can sit together and help them to address the go-to-market. That's one way. So the other one is the expertise. Within Amadeus, we have experts on many different topics, be it around revenue management or transaction processing. So those are very valuable expertise that we can also share as mentors or sometimes board observers with our portfolio companies, and as the sounding board for the startup CEOs to actually test out different ideas and seek advice. So and all of those are the things that we are actively doing with a lot of our portfolio companies.
Christian?
And frankly, a lot of what we had, or what we tried to do for our founders over the last years was really giving moral support, if you want to, because as Christoph said, it has been a super tough time. I mean, one of the companies I'm involved in, they had to lay off maybe 2/3 of their people during the pandemic, because the business obviously hit a wall and revenues went to zero. So they had to adjust the cost structure very, very heavily. And I mean, of course, that's a super tough thing to do. And then they came out of the pandemic and were growing again, and we're hoping to then raise money to speed up growth. And then the next shoe dropped, and this was basically very tough to raise additional money. And just helping founders through these tough times, and knowing that there's a partner on their side who supports them, I think was hopefully something helpful and valuable. And then the other thing we try to provide is this sort of external perspective of where markets are and where the right balance is between, looking at economics, looking at the bottom line, but also not forgetting about growth at the same time. And it really is important to find a balance here, because all startups that we are involved in, they cannot shrink their cost structure to a point where they are profitable and then be interesting businesses. I mean, it's still about growth on the one hand, but it needs to be sort of profitable growth. And finding this right balance is something that, yeah, for us as investors, where we are involved in a lot of businesses, we can hopefully provide a perspective to find the right balance.
Yeah, and I'm guessing some of these founders, given the extended sort of run of good years we've had, have never faced those tough times, right? So there's a lot more sort of support that they need to get through this. I said in my opening this morning that, generally, if we look back to the 2007-9 period, that was when some of the most innovative companies or products came out. And so what do you think right now? What excites you? What's sort of, technologies, what kind of products do you think we'll be looking back a few years down the line and saying, yeah, this was a tough time, and but this is what sort of came out of it. What's the next big thing?
Yes, within our portfolio, we actually have we have invested in a company that has like Uri Levine as the co-founder, and he has this saying: "Notice that fall in love with the problem, but not the solution." And I think that's a very wise comment that he makes. And the concept that we invested in it's like look for places where the processes are broken, where the user experience is really subpar. So his startup works on the problem of VAT refund. So it's based in Israel called Refunded. And those, I would say those will remain to be like something that excites us. It's a big problem that whenever you talked about it to different people, like they would have personal stories to share, because it's such a wide and deep problems that everybody is experiencing that are waiting to be resolved still. And I believe there are going to be still many of them, like within the travel industry.
One area that I find interesting right now is, like, if you look at small travel providers like independent hotels, small hotel chains, tours and activities providers. I mean, they've been rather conservative in the past about sort of digitizing and modernizing their experiences, and it was always like difficult to build big companies in the software for these space for these providers. But now I think that has fundamentally changed now, because first of all, after the pandemic, all customers, all consumers expect more streamlined digital experiences, and secondly, because of the labor shortages that the whole travel industry is experiencing, yeah, hotels and all of these other smaller providers need to do something and changing their processes and becoming more efficient. And so I think now is actually the time when a lot of these, yeah, B2B SaaS businesses for these companies will be being built and will become big.
Christoph?
I think it's interesting. If you look back, travel 20, 30 years ago, so it was like waves. So after the GDSs who opened the market for B2C, then OTAs came with Booking, Expedia and others, and then the vertical winners were coming in, let's say, for tours and attractions, for ground transportation, for flights and others. And then social travel was the next big thing. And I think now it's time for this kind of overlapping exercises like payment plus travel, embedded travel. So this is something which is getting interesting. Then infrastructure play, more B2B, all the kind of asset-light B2B2C related businesses are interesting for us. And so I think the vertical B2C story is already told. I think there's not a lot to add. Social commerce in travel, I have to say that was a bit overhyped because it's more discover than transaction. So that was the problem for all the approaches. I would love to see someone who's better in transaction, but they are all more on the discovery mode. And meta is also something which was really hot, but there are only just a few who are able to be profitable in just a meta play. And so I think the next one is an overlap play and an infrastructure play. Let's see.
That's great. So near term, focus on profitability, focus on unit economics, but really there are a lot of hills for travel still to climb and lots of opportunity. That's the message I'm getting from you.
Yeah.
Thank you very much. Our panel, Suzanna, Christian, Christoph. Thank you.
Thank you.
Thank you.